Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron try to design an algorithm for a do-it-yourself tax loss harvesting program. They illustrate the benefits of harvesting with specific equity ETFs. They then debate how often to check for losses and how to maintain asset allocations after realizing a loss. They also propose how to get back to your original portfolio while avoiding wash sales. And if you want to make all this work well, don't forget to track individual tax lots instead of average cost basis. And now onto our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So I had a client conversation a couple weeks ago where I was describing the tax loss harvesting program for an ETF strategy. I use SEI as my custodian and platform, but the concept was the same as what Betterment and Wealthfront use with their tax loss harvesting program. Both the platform costs are on the scale of 25 to 35 basis points. And he is really interested in learning the mechanics of how this works. I have quite a few clients who are in engineering. They are in the tech space, and so they do like going into the details, make sure they understand something. And he came back kind of after the conversation, like, could I do this myself to save money on the platform fee? And in fact, could I even write a script to do this? Where if he understands the rules well enough, could he do the tax loss harvesting himself? And I try to make sure that yes, we can make it rules based enough and determine an algorithm that if he enjoys the writing the script part, because that's kind of the life planning side, is yes, you could save the money on the platform fee, but it's your own time and energy to actually manage that if you want to do it yourself. But that's why he decided, yes, if I can write the script, he would actually enjoy writing the script enough to then save the time and save the money. And I was really struck by that. I like the idea of, again, people doing the things they enjoy. That's the life planning side of it. And if it saves him time or saves him money, and the time he spends is not a kind of working or drag kind of feeling, but he actually enjoys it, then yeah, this could work. And I was thinking, okay, so if we need to be able to do this, we have to start getting very specific on all the components of an algorithm that go into tax loss harvesting. And because Trishul and I have talked about how important this is and how this is one of the big values of working with an advisor, we decided we'll try and go through kind of step by step, identifying the mechanics. We'll throw in a little bit of theory, kind of especially on the investment side. But if you were to implement your own tax loss harvesting program or algorithm, how would you actually do that? So we'll try. I'll identify a few ETFs, and I'll give you a few tickers. Trishul could probably describe how he does it. I think he uses software to help him with that. But at least we're going to go through step by step of the mechanics with tax loss harvesting. So Trishul, why don't you start us off of one, if we have an ETF asset allocation, we have our starting point. What would that look like? Just give us a quick example of one of your asset allocation portfolios using ETFs for a client. You can choose 100% equity or 60-40 portfolio, but what are some of the ETFs that you actually use to put together that strategy? So what would our starting point be?
Right. So for myself, I recommend strategic model portfolios. And what that basically means is it's a portfolio that's strategic in nature. It's not designed to be tactical, meaning make short-term plays, but it's more designed to provide long-term benefit. And it's a model because it basically aligns with a theory or a set structure. And what I also recommend is a globally diversified portfolio of stocks and bonds. So at that point, what we're talking about from my perspective is generally ETFs. And what we want to do with these ETFs is we want to provide as much coverage as possible. At least that's my goal with these models, meaning we want to cover as much of the planet as possible. That's what I try to do. And with a selection of ETFs, I'm able to have about maybe 19 to 20,000 instruments, but distilled down to, about a dozen different symbols. And the idea behind these ETFs is, again, they should cover all the major areas where there's securities. And typically this includes the US market, which can be value, growth, small caps, and so on. We also want to think about international markets, developed and emerging. And we also want to think about the bond markets. So depending on different tax situations, you may want some municipals. You may want if other types of bonds that are across various durations, short, medium, and long, and other various bonds that are domestic and international, and also thinking about credit quality as well. So with this universe, you want a set that, again, can hopefully cover enough, or at least that's my goal, cover enough of the world without actually overlapping instruments, because you don't want the same position to show up in two different buckets. Then it makes things a little complicated. So to provide this global spread, you can accomplish this, in my case, with a set of, for example, like Vanguard ETFs.
So that's actually a good point. And I think I gave you the option of choosing like a 60-40 portfolio. But now that I think about it, on the bond side of an ETF strategy, this would be for a taxable account, because that's the only way you can do the tax loss harvesting. I tend to use California muni bonds as much as possible. Just California's a really high income tax state. And so when you said a dozen ETFs, I was thinking that's actually more than I use. But I then realized I have all the same equity allocations that you do. I just will only defer to one, maybe two bond ETFs. So in part because on the ETF side, there's only a couple California muni bond ETFs, and I prefer the iShares intermediate term California muni bond ETF. I think it's CMF is the ticker. I'm going to double check that really quick. And the other part is with bonds, when you think about a tax loss harvesting strategy, because most of the growth of bonds in a portfolio is interest income that gets reinvested, there isn't usually much of a gain or loss at the price level on the bond side. There might be some, but it's usually small either way. And that's actually why we have bonds in the portfolio. We're not expecting the prices of the bonds to go up or down very much through market volatility. That's why we use the bonds in the first place. So I think for today's conversation, we can probably ignore most of the bond side. The exception might be something like high yield bonds, the junk bonds, where those have shown correlations to equity markets and can get the higher returns, but also the bigger losses to harvest. So maybe that is some place that if you were using high yield bonds, you could get some loss harvesting benefit. But I think for today's conversation, we'll say if we have a 60-40 portfolio and you're a resident of California or another high income tax state, then muni bonds would be the preference. That will provide the tax benefits, but we may not get much tax loss harvesting. So I think we'll focus on the equity side then. So again, I agree with what you said. I was looking at, you could use like a Vanguard's US large cap value, I think it's VTV. Vanguard's US large cap growth, ticker VUG. Vanguard's small cap value, I think it's VBR. Vanguard's US small cap growth is VBK. The developed markets use the MSCI EAFE index, the EFE index. Vanguard has the ticker VEA. And for emerging markets, Vanguard's ticker is VWO. So I think those on the equity side, those, 6 ETFs tend to be the components that I look for as a starting point. I was curious, like, does that fit, or do you add in anything else on the either equity side, or you want to comment on the bonds?
Well, just a small comment on the bonds, but it still aligns with what you're saying. The notion, though, is if a client isn't in one of the higher tax brackets, then I may still use some of these other bonds, but beyond the municipals. But, as you have stated, those are probably less likely to provide the opportunity for the tax loss harvesting notion that we're talking about today. So it certainly does make sense to think more about the equities. And yeah, for those equities, those are the tickers that I would probably look at as well.
Okay, so we have our starting point. We have an allocation. I'm actually really curious. So do you want to share, if you were putting together a 100% allocation, 100% equity allocation using those 6 tickers, what would your weightings be? Do you know off the top of your head, or do you want to double check that?
Yeah, I'm happy to share that. Let's see here. So 100% equity allocation. So, okay. So to be fair, I don't split up the small cap value and small cap growth. I keep them combined with the VB, but that's probably the only difference. And in that case, I have 5 instead of 6. So my rough breakdown is the value and growth is roughly, out of the whole pie, that's roughly like 50%-ish.
Okay.
Now growth has done better, so that's a larger share. So that's roughly, like 30% versus around like 22 to 23% for the value. And you combine the two and you get about 52%. Now that 52% roughly represents the amount that the value and growth stocks for the large caps as what they represent in terms of the global share of equity, frankly. Mm-hmm. So that's what I pegged that to. And it's interesting. Well, 2 things to note though, you add the value plus you add the growth, you get basically a blend of the two. And that blend of the two is the S&P 500 basically, or basically all the large caps. And what that's kind of also saying is, the large caps within the US represent about 52% of the global equity market.
Okay. So you have large cap is 52%, and you said you combine small cap value, small cap growth.
Yeah, you add the two together and you get something about 6 to 7%.
Okay. And then what do you have for international, developed, and emerging markets?
Right. So, if you add the value, the growth, and the small cap together, then you get roughly about 59, call it 60%. Then the rest is international. So what that kind of means is, of the total equity market capitalization of all the stocks, that are publicly traded, about 60% is US, 40% is international. And what that roughly means on the international side is, now we have this 40% left. So 30% is developed and 10% is emerging. So that's the full pie.
Okay. So I'm actually, knowing your investment background, I'm always happy that my numbers are really, really close to yours. I think I've looked at like the Vanguard total stock market, which is the US. About 1/6 is small cap. So, and then on the the Vanguard Total International stock. About a quarter of that is emerging markets. So I use that kind of as my guide. But I had 60% US, 40% international. Of the 40% international, 30 is developed, 10 is emerging markets, so it's identical to yours. But then I went of these 60, I think I had 12% in small cap, and I break that 6% small cap value, 6% small cap growth, and 48% in large cap. So 24% large cap value, 24% large cap growth. So I would be a little overweighted on the small cap side that compared to you, and I've underweighted US large cap just slightly.
Yeah, I mean, I think these portfolios would likely be very highly correlated.
Yeah.
You might not, you might not be able to see two lines on a graph if you plotted their wealth over time.
It is, yeah, even the expense ratio is going to be right about the same, because I know the small cap ETF expense ratio might be slightly more than the large cap, but not by much. But yeah, I agree. I think these are going to be very, very highly correlated on like 95+%.
Right. Yeah. And there's subtle differences between, benchmarks that an individual may tie these to. I like ACWI, which is the All Country World Index. This represents the global capitalization. So that's kind of what I look towards for insight into some of this.
Okay. And I think that the reason I do break out value and growth in a taxable account is specifically for loss harvesting opportunities. Kind of like in our discussion with the direct indexing, when you have more components, there's just a better chance that, say, small cap value is flat, but small cap growth is down and negative. You now have that tax loss harvesting opportunity that if they were combined, you may not. But I think, kind of fitting to your point, if you only have 6% in small cap anyways, and you're like, to break that down into 3 and 3 as a percentage of the holding, depending on the size of the account, there could be some restrictions. Like if you have $100,000 portfolio, trying to put 3,000 in small cap value and 3,000 in small cap growth, one, I think some of the ETF or some of the mutual funds might have a minimum some of the index funds have a minimum of around $3,000. So I can see breaking that or combining those two components, just so that your smallest holding is at least 6% of the portfolio.
Right. Yeah. So the other thing that we might know is you could buy the whole shebang with one ticker. Like you could go out and buy the world with, so Vanguard, that would be VT. And what that means is you would have pretty much the same instruments all boiled down to one security, but you give up two things. You give up this tax loss harvesting notion because you're just invested in one thing. There's only one thing that can zig and zag.
Mm-hmm.
Whereas if you have more of these opportunities, like you said, by breaking it down into smaller chunks, then you're a little bit better off. And the second thing you kind of give up if you're just distilling all of this into one ticker is it makes it harder to do a asset location type of strategy. So that's the other reason why I like to break these up. Meaning I may put some of these tickers that are more likely to throw off taxes into retirement accounts. And I may put some of these tickers that are more tax efficient into the non-retirement accounts. So, for example, growth companies are growing, they're less likely to pay off dividends, so they might be more sensible to put inside of your taxable accounts. And, other tickers are more likely to give off dividends, like a value company. It's more established and they're designed to have distributions, or more likely to have distributions, and they might be better placed in another type of account. So there are some sensible reasons on why you may not want to titrate this down to too few tickers, and having more tickers is better than less.
Yeah, I think going back to like our conversation about just the easiest investing, I love that single ticker, that asset allocation strategy. I've also seen both a few clients that they came to me with a strategy. I was like, you know what, that's good enough. We'll leave that alone. They'll do half Vanguard total stock market, half Vanguard international total stock market. And it's like, yeah, I'd like it to be 60-40 US to international, but half and half between those two ETFs, I have no problem with that.
Yeah, that's fair. There's certainly edge cases in terms of what a client comes in with. And, if it's a situation like that and we want to get to 60-40, then, new contributions can be shuffled into the right bucket so that over time you'll be closer to where you ideally want to be.
Yeah, that's a great point. As much as I can, when possible, I'll try to avoid realizing a capital gain just to sell out of their current holding and moving it to something that might look and feel almost exactly the same. So I've been able to help clients kind of take their current holdings and build an investment strategy around that, so that they, as long as they're kind of getting the low cost ETFs, then we can use new money, usually from selling company stock, to build out all the other components, but we don't have to sell what they currently have. Sometimes we can directly incorporate it into the strategy and it starts to get rebalanced and incorporated with tax loss harvesting. Other times we'll just kind of hold it off to the side and adjust the allocation of the rebalancing, and kind of keep an eye on it manually.
Right. Yeah. So what you're basically talking about from our perspective is we have like a stage zero. What are you coming in with? And we kind of align that to where we want to be, and we have to make thoughtful decisions. If it's a retirement account, it's very simple. Just sell everything. A minute later,
sell everything, transfer cash.
Right. Or just transfer securities in kind, and then once the securities are here, within one trading minute, just sell everything you don't want and buy everything you do want.
Yep.
And don't have to worry about taxes. But if we're talking about a taxable account, we just need to be a little more thoughtful. And often, if the client already has a growth index, then we don't need to sell that to buy another similar growth index, unless there's some concern with like higher fees, or if there's a loss, then, oh, great. Yeah. Sell that right away. And, let's get something a little better. But it's a little bit of massaging to get it where it might need to be. And sometimes we come up with a plan. We're going to say, it's going to take some time to get from here to here, but we'll eventually get there, looking for opportunities to get closer and closer over time.
Sounds good. Okay. So next one. So, okay, we have our starting point. We have we're going 100% equity. We have our combination of Vanguard ETFs. And let's say, okay, so I guess what would you think would be the next step in developing an algorithm? Like if my client's writing his script, what is the next step? I have a thought in my head, but I want to kind of see what you think of first.
Well, I'd say it's all part of the design. So we should probably design this out a bit.
Yes.
And as part of that design, we would probably need a workflow. Like, how does this process work end to end? And we want to think about the workflow from a few different perspectives, meaning there's sub workflows within the overarching workflow. So the sub workflows that we want to think about are initially, we're going to want to think about some sort of scheduler, like how often do we want to run this thing? And that can be like a parameter. Do we run this thing every day, week, month, year, and so on? And once we have that notion, we also want to think about when we do run this thing, okay, what are the steps we do when we run this tax loss harvest? And then, the third high level process we probably want to think about is, okay, so with the tax loss harvest, you're going to harvest these losses and you're going to jump into substitutes. We should probably talk about at a high level what all this means. But then at the end of the day, you're going to have to do some cleanups, meaning if you're in these substitutes, you're going to have to go back to your original or clean up your position so that if you're in a substitute, you may want to transition to your original model. So those are three high level processes, but I feel like maybe we should just also mention what's the high level goal and the rough idea behind the tax loss harvest.
I like that because I had your first two almost identical. It was the timing component and when there's a loss, what do you do? But yeah, you're right. The third would be kind of getting back in, like after you harvest the loss, what do you do? But I do like that your point of why it's good kind of reminder of why we do the tax loss harvesting. So when you generate a capital loss by selling an ETF, if you had $100,000, you have enough, one of the components goes down $5,000, you have a $5,000 loss that can then be used to offset any other gains that you incur that year. So if you happen to later sell enough because you need to take money out of the portfolio or as part of the rebalancing, we've now offset those future gains. So you don't pay taxes on those capital gains. Whereas if you buy a stock or buy an ETF, it goes up 10%, you sell it, you owe taxes on that capital gain. But if we have the loss in place first, that can offset that gain. And this happens at kind of each calendar year. So within a calendar year, if you incur the gain first and then the loss later, those will offset at the same time. If you incur the loss first and then gain later, again, same offset. If you don't have enough gains for which your losses can offset, you can use those capital losses to offset $3,000 of ordinary income. So your normal salary gets reduced by $3,000, and depending on your tax rate, you might save on the scale of $1,000 in taxes. So that's the first level. If you can have $100,000 portfolio, a good loss harvesting strategy that can offset ordinary income can easily save you 1% of the portfolio. That's a very realistic expectation. Again, if we have the losses. If we don't have losses, it means all your investments are going up. So that's always better. You're always better if your investments are going up and you're paying taxes. Your net is always greater. But in this case, we know the stocks we pick aren't always going to go up. So here's something we can do to take advantage of those losses. But the key to tax loss harvesting is really that you can carry losses forward to future years. So when I said the gains and losses can offset each other, so you can have the gain first and the loss as long as it's the same calendar year, but you don't know when those losses will occur. You don't know when the market downturns will occur for you to realize those losses. And so by having the program in place, it is very possible that you realize the loss in 1 year, don't have enough gains that year for the losses to offset. It actually takes the next year or the year after, because you've been able to carry forward your losses from 1 year to the next. You can offset those future gains, where those future gains are now non-taxable. You don't have to pay taxes on those future gains. But the timing only works one way. If you realize a gain the first year and there's no loss to offset it, you pay all the taxes on that gain. If you then get a loss the second year, you can't offset the gain in year one with the loss in year two. But you can offset the loss in year one with the gain in year 2 or 3 or even farther. So having this program in place, that's why it's called harvesting these losses. You're gathering them up to offset future gains. The losses almost always have to happen first, and either it's kind of getting the same calendar year, but it's a very realistic possibility. If you harvest enough losses, you'll carry forward and you'll offset $3,000 of ordinary income each year. So you kind of slowly eat away your loss. But eventually you're going to realize a big gain and you can offset a lot of that. But you have to harvest the loss first. Do you want to add anything to that, kind of how the taxes would work, or understanding kind of some of the quantifiable benefits?
Yeah. So just to kind of build on that a little bit, and the high level notion is you could have a buy and hold strategy where you just buy, for example, the S&P and you hold it indefinitely. However, again, what we're saying is there could be opportunities along the way where if you're buying the S&P, more and more each year because you get more money as income, you invest in the market, there could be opportunities where, that amount that you invested this year, not the bulk of it, which is up, but that amount you invested this year happens to be down this year. And it's that amount that is down this year that you could use to offset either gains from this year or future gains. And that's what the tax loss harvesting strategy is about. It's realizing that you may still want to keep the S&P, so you don't want to sell all the position. And also you don't want to, if you do sell the part that's just a loss, you don't want to kind of sit on the sidelines either. You want to still remain invested in an equity type of market that resembles the S&P. So something we're going to talk about is you're going to be selling the S&P and jumping into something similar. I'm jumping the gun, but that's the notion of tax loss harvesting. You want to still stay in. You want to keep this position because you like it over long periods of time, but you want to capture these losses along the way.
That's a great point. It's kind of goes back to what we said before. Asset allocation is the most important part. We're not saying sell out of the ETF and leave it in cash. It's still more important to maintain that asset allocation. And we've seen enough examples. In March 2020 was the most recent example where if you went down, realized the loss, you waited 31 days to avoid the wash sale, and we'll get into that a little bit later, to get back up, the market already recovered. And that's how you need to participate in these buy and hold strategies, is you need to stay invested for your time frame, because the markets do have that kind of volatility. So it's the tax loss harvesting strategy is that component of realizing the loss but staying invested, keeping our asset allocation in line with our time frame goals, risk tolerance, etc. So I think that's a really good addition to understanding, is that we're not just harvesting the loss and leaving it in cash. We need to stay invested.
Right.
Okay, so let's go through the timing conversation. So I've read some kind of academic papers, but kind of how to implement loss harvesting in terms of the timing. What's your first thought?
So what kind of comes to mind is it's a decision you have to make, and there's some pros and cons. There's probably no one hard and fast rule and no set answer, because what you probably want to weigh is if you do this too soon, well, there won't be opportunity for a loss to occur. Meaning if you're doing this every day or even sooner than that, well, things aren't going to move as much. So there's not much to capture. And you might end up eating up your benefit in the time, and B, there could be some trading friction to getting in and out of these things. For example, even with zero cost ETFs, you still have to cross the spread, and that can eat away at your returns over time. And that's something to realize. Even though your commissions may be super low and whatnot, you still have to pay a little bit of spread between the bid and the ask price to get in and out of these positions. So that's one thing to consider on kind of doing this too often. But also you don't want to wait so long so that you're missing these opportunities. So that there's probably some sort of sweet spot of if things have moved enough, meaning like a March of 2020 type of situation, then those areas might be more opportunistically favorable to run this type of strategy versus like a period we've seen over the last many months where things have been relatively calm, a lot less opportunity. Because I'd say at a high level, probably most of your benefit from this type of strategy is going to be during those periods where you do see kind of like a correction, like a down 10% within a short period, or you see a pretty big drop like you saw in 2008?
Yeah, I think the I won't say the best research. I guess the best research says something like check often, execute occasionally. All right. Now the definitions of often and occasionally will change based on researcher and theories, but something like checking weekly or maybe even daily, but maybe only placing the trades on the scale of once a year. Like that's just kind of in terms of when there's enough market volatility uh, to actually enact the loss harvesting component, combined with just kind of how often that volatility happens. So kind of how often do we see a 10% drop in an equity portfolio? It's again maybe on the scale of once a year, but we looked at kind of say March of 2020 as our example. Looked like there was a small peak around February 9th. The bottom was kind of March 15th, and then recovered back up by recovered a lot of it within a couple weeks, and then most of it was covered by about July or August. But the reason I bring up these timings is just trying to check on a quarterly schedule. If you say, for example, we're checking end of March, you actually might have missed about half the loss that you could have realized from that drop from, again, February 9th down to March 15th. That by the end of March, it had kind of come halfway back up. So that's why the timing, like a quarterly rebalancing is another example of this, where if you had to pick an automatic schedule, quarterly is kind of emerged as a good balance between not doing it too often, but doing it often enough. And it's kind of the idea with tax loss harvesting. If you looked or kind of did this at least quarterly, you might get a good amount of the benefit, but the best benefit is if you can kind of check even more often than that, but you may only get one chance per year to really execute it. I know, was it December of 2018? There happened to be kind of towards the end of the year, but I think it bounced back up a little bit by the actual December 31st date. So even if you kind of picked end of the quarter, you might have missed it. You had to kind of do it middle of December. So I think those are the only two real opportunities that I could think of was December 2018 that kind of was big enough, and March of 2020. There might have been other drops that on the scale of 5%, so you might have been able to kind of eke it out, but those big benefits were those two timeframes that I can think of.
Yeah, that's roughly it. I mean, if you do see a pretty large drop within a short period, it's probably something you might even see in the news and whatnot. There'll likely be headlines going on. So, for example, notable things that have come up over the last many years, Brexit had a large mess, and then there was a pretty big volatility spike, I think, at beginning of 2018, and other situations where you've seen some spikiness where around, if you recall it, there was a period where you had Trump and his tweets relating to North Korea and their missiles and a bunch of stuff like that. But these are all kind of minor in comparison compared to probably the big, again, opportunities, which frankly, we haven't really seen in the last 10 years,
That's true.
Like a 2008 situation. So it's one of those things where I think we had mentioned this in the past. A lot with a tax loss harvesting strategy is you might be eking out kind of like pennies every now and then, but it's really those big opportunities where in like a 2008 situation, you might make up the lion's share of what you would expect from this type of strategy.
I agree. And so I was actually able to implement that for a lot of the clients of my former firm in 2008. the loss harvesting programs weren't quite as robust, so I was doing a lot of it manually. But for some of our clients, if they happen to have $1 million in 2007, their loss might have been on the scale of $300,000 or $400,000, and so they carried that forward for 8 to 10 years, something like that. It's for some clients who were retired, they're kind of drawing from their portfolio. And we did a lot of planning work of, okay, here's the adjustments we need to make, here's how much we can take, but they were withdrawing from their portfolio. They're living off their income, or living off their investments. And so they were selling out of their portfolio pretty consistently. Again, following withdrawal rates and Monte Carlo simulations, they're selling out of the portfolio. They didn't pay taxes on the gains from selling those investments for some at least 5 years. Some of them closer to, again, 6 to 8 years. But at the time, they thought, I will never have enough gain to offset $300,000 in losses. Now, again, they were at a different stage of their life, but the concept's still the same, that if you have $100,000 and we see a 40% drop and you realize a $40,000 loss, you can use that to offset gains. Even if nothing else, you can reduce your ordinary income by $3,000 a year for the next 10 years. So depending on your combined federal and state tax rate, that might be how you make up for any costs in the kind of tax loss harvesting programs. But yeah, when you get those 2008 situations, when you're ready to implement something like this, the benefits can last a long time.
Yeah, and one comment about the benefits. So what we're kind of really talking about here is that the benefits are a little bit subtle, because it's not necessarily free money that you're getting, or free incentive. It's a bit subtle. So the notion is, let's say you lock in a loss and you offset ordinary income. Well, that's better than using that savings for long-term gains, for example, for long-term losses. So ideally, if you can capture short-term losses versus long-term, then you do get that savings benefit. And that's if you held a position for less than a year, or if you're using it to offset that $3,000 of ordinary income. So that's one benefit of putting a strategy like this in play. It opens up that opportunity. Whereas if you didn't, you might just be stuck with, like a long-term loss down the road, or just no loss at all, just a long-term gain that you didn't really offset with anything.
That's a good point. And the other kind of component is, over time, this does tend to lower your basis. So it's like, I agree that the true lifetime benefits are a little more subtle, where it might be more control of when you realize your losses and gains, and if you have the losses to offset, you can be a little more opportunistic when it comes to realizing gains in terms of the tax benefits. It gives you flexibility, gives you a little control, so you can decide, okay, I'm going to take money out of my retirement account this year, but I want to keep it under a certain tax bracket. So my tax rate on my retirement account withdrawals is lower, but that's not enough to support my lifestyle. So I need a little bit more from my taxable account, but I have the losses to offset that. So it's kind of in concert with all the other financial planning components. This can help reduce your tax rate slightly. So kind of, if you realize a loss when you're working, your tax rate might be higher, versus when you're not working, your tax rate might be lower. You can kind of choose when to pay the taxes. And then under current law, if you lower your basis and never actually kind of use it up, then you got to step up, your heirs and beneficiaries got to step up in basis. So that's kind of the end benefit of you've incurred all these losses, reduced your basis, over the years and then eventually get stepped up. But we'll have to see if that loss changes. And I think that'll be an interesting research perspective of if the step up in basis is repealed, how much of the benefit from tax loss harvesting still exists. I think it's still there, but that might be one of those other last subtleties.
Yeah, that's a good point. So if you're not going for the step up in basis and you're trying to use this type of strategy, here's what you're kind of banking on in that case. Well, the control situation is, you buy IBM for 100 and 20 years from now, you sell it at 120. So you made a 20% profit and you pay taxes on that $20. And with a tax loss harvesting strategy, what that means is, let's say you again bought IBM at 100 and it drops to 80 pretty quickly. Well, at that point, you harvest that $20 loss, but your basis is now reset to 80. So when, 20 years from now or 19 and a half years later, you sell it for 120, you're going to be paying taxes on $40 of gain. So the net amount you pay in taxes is still $20 in both cases. There's no magic there. But the difference between the control case and the alternative case is, in the control case, you pay the $20 in taxes all the way at the end. But in the alternative case, you got a tax benefit right up front, this year of $20. You get that today. You get to use it sooner, meaning time value of money. That's good. And yes, you had to pay $40 in taxes down the road. But if you combine, the notion of having to wait that much longer to pay the 40, well, then hopefully, the time value of money has helped you because you were able to stave off those $40 for much longer.
That's a good point. The way the math works out, you're doing that, the growth of that opportunity cost. So you take that $20 and reinvest it in the same IBM, the IBM proxy, because we don't want to, by the way, watch sales. Realistically, it'll be something like your tax bill is slightly lower, so your checking account is just a little bit bigger, or you get a slightly bigger refund, and then you have a little bit extra money to either put towards goals such as building up a cash reserve or reinvesting, kind of investing that excess. So if you get a tax refund and you consistently invest that tax refund, that would be an example of taking advantage of that opportunity cost. And then can we get 10 years on that extra few $1,000s, 10 years of growth? That might be enough, where both, if you pay the taxes in the future when your overall tax rate might be lower, so one, kind of your tax rate is probably higher when you're working, probably a little lower when you're not. You can probably combine with other strategies. Maybe you take withdrawals from a Roth IRA, and a decent amount of the gain might be 0% capital gains. If you can kind of do that a few years in a row, you can keep your tax rate really low that way. But the kind of, that's I think that's what I'm trying to illustrate by that idea of control. But yes, you're right. The theoretical reinvesting of tax savings is where the math really starts to pay off.
Right. Yep. Sounds good.
Okay. So we have our 100% equity portfolio. We are going to check, if you were writing it, so I think in the conversation with the client, because he's writing a script, he's going to have it check daily and send him an alert if any holding has a loss, or the value of the holding is 98% of the basis. I'll be curious how he actually programs that, but the idea is that if a holding has a 2% loss on any given day, it'll notify him. And he can adjust this over time. If he's getting too many alerts, then he can change that. You could also set it to be a dollar amount. Maybe you need $100 loss in a holding to get an alert, or try to, what would your parameters be for triggering that alert?
Yeah, I think it should be based upon, just some amount of loss, that sense of, well, there's no empirical right answer to this. And in fact, again, probably taking these losses too soon may run into some trouble
Mhm.
because of the wash sale considerations. So since we're bumping up against that, it's probably good to just kind of put that on the table. What are we talking about with the wash sale, since we've mentioned this so many times? Well, the notion here is, let's say you have this model that says you should hold S&P, and if S&P is down, you want to harvest the loss, so you sell S&P. Well, what the government is saying is you can't sell S&P and then immediately a minute later go back and buy S&P and keep that loss. Well, and the reason for this is there's a rule called the wash sale rule, meaning you have to wait a period of 30 days before you can re-enter a position in order to keep that loss. And one way to use this rule to some more advantage is, instead of buying the S&P immediately, if you still want a position that represents the equity market movement of the S&P, well, you can buy, like the cousin of the S&P, something that's similar but not quite the same. That way you get most of the movement because it's highly correlated with the S&P, but it's not exactly the same in the eyes of the government. So it's substantially different. That's probably what we're going to be looking for. And there's no hard and fast definition of this, but that's kind of what we target when we run this type of strategy.
I think that for practical purposes, if you went from the S&P 500 to the Russell 1000, that would definitely be different enough. Those are very, very highly correlated, both US large cap, but the indices are different. You could also use, so I think, I know SCI as their alternative fund uses the Schwab Value ETF and Schwab Growth ETF for large cap growth, large cap value. For the small cap, go from a Vanguard ETF to an iShares ETF. That usually you'll want to double check, but those are usually different enough when it gets to ETF construction, whether they are explicitly matching the same exact index, because sometimes ETFs will, I forget the phrase, the two definition of the words, but they will have enough of the securities in the index to match the performance and volatility. So kind of for the large cap value, or let's say large cap blend, you can match the return of the S&P 500, but you don't actually need to hold all 500 securities. You can kind of use statistics to match the return and match the volatility, but do it with a third of the securities. You only need 100 to 200, something like that, to actually get the same exact performance. And so I thought it was composite or representation versus replication. I think that's what it is. Representation versus replication. And so as long as you're avoiding two ETFs that are replicating the exact same index, I think that would be the definition of violating a wash sale rule. But as long as they're both representing the same asset class, then you're probably fine.
Yeah, roughly. The disclaimer here, of course, is consult with your tax professional.
Yeah, we are not. Yeah, that's good. We're not CPAs. We're not attorneys. We're not tax professionals. That's a good disclaimer to add here. So that's why I defer to using SCI. I know, and so they put together a list of which ETFs they use, that they've done the due diligence to make sure they do not violate wash sale rules. And so they use, again, is Schwab Value, Schwab Growth for the US large cap, iShares EFA, for the IEFA for developed markets equity, IEMG is iShares emerging markets for emerging markets equity. I think they've done like EEM. Is that the emerging markets equity? I'm trying to remember that off the top of my head.
Well, that's the index, yeah.
Yeah, but the IEMG just have lower expense ratios as their core. So, and then that, yeah, iShares and Schwab make good ETFs as well, have low expense ratios. And if you go from Vanguard to one of those other ETF companies, you should be okay. But again, defer to your CPA. And this is why I depend on one of these platforms to do that due diligence.
Right. Yeah. So the other thing you might want to think about for this script is, okay, so you're running this every day. You're looking for the losses of 2%. But one thing to realize is you may have purchased, like the large cap value index over many different periods over the last 5 to 10 years. So the question of being down 2% gets a little more subtle because on average, you could be down 2%, but you could have some positions, some lots. We talked about this before.
Mm-hmm.
Whenever you purchase, you create a lot with a actual cost tied to that lot. And some of those lots could be down and some could be up. So you would have to track these returns on a per lot basis, because even within a given day, if you're buying 1,000 shares of IBM or 1,000 shares of VTV, the large cap value index, you may have different prices that you entered into different amounts of shares. So you need to track those individually in terms of what's a loss and what's a gain. So that's something that the script would likely have to do so that it's capturing the right losses to actually harvest.
Yeah, and that's good. In our example, we started off, if our fictional portfolios at $100,000 goes up to $200,000, that wasn't necessarily all investment growth. We probably added our own money. So the money that we put in when it's at $200,000, if it drops 25% down to 150, our original basis, our original shares may not have a loss, but it's very likely that we've invested something, even just dividends reinvested. But for most people in the accumulation phase, they're adding money to these portfolios over time. There's usually at least something that has a loss, some individual tax lot, even if the overall holding does not.
Right. So the script wouldn't only be looking at, let's say 12 tickers, but it might be looking at hundreds of lots.
Yeah. And you can start to see kind of why these programs kind of cost the way they do. There's a decent amount of both kind of checking computing power, but also kind of getting this right and tracking this of hundreds of lots per each individual account, and then also executing in these. I do feel that 25 to 35 basis points in terms of both custody statements, reporting, kind of meeting all of those regulatory requirements, and then getting the loss harvest strategies right, that feels like fair value.
Yeah, it does kind of seem like that. Frankly, being an engineer myself, when I first learned about this notion, I did think up the notion of, okay, I'll just come up with a little tool or some widget to help me do this type of thing. But I did realize it does get a little more complicated when you're talking about if you have multiple accounts and you have moving prices and legacy positions and different lots to think about, and short term and long term. And, there is quite a bit of things to think about. And I definitely feel like there has been a difference since I moved to a more institutional platform that has software to do this. So on my end, I lean on TD Ameritrade's institutional platform, and within that, they have a tool called iRebal. And the goal of that tool is to do all of this using software so that I don't need to open up, tons of spreadsheets and connect up a bunch of numbers and tools and charts and stuff to get all this right. The software handles and it opportunistically figures out, okay, here's the actual amount of losses, here's the gains, here's what can be offset, and it does it kind of automatically by clicking buttons rather than hoping that the software doesn't have an error at an edge case.
Okay, so we're gonna check daily. We have to check at the lot level, and we want a loss that, I think 2% is probably you want to have at least 2%. That's gonna be like the minimum variation. You can probably even go to like 5% per holding. We're trying to balance like not getting too many alerts, but you're ready, that when it does have that, we're kind of ready to take advantage of. So, or maybe depending on the size of your account, you could set it at a dollar amount. Maybe you want to generate at least $3,000 in losses. But even then, like that, if that's a goal for the year, it might make sense to add up three $1,000 losses.
Right. So at the end of the day, you don't want this to be a second job, because
Yeah.
if you're only gaining $3,000 in not profits, but
Yeah.
in deductions, depending on your tax rate, that's going to be the most expensive couple $100 you've ever earned.
Yeah. That's a great point. You want to kind of make sure. So yeah, you probably want to set this up so that it's only giving you an alert. So ideally, the script's checking every day, but you only get an alert once a year. To kind of, maybe you get an alert 4 to 10 times a year, but then you go in and double check. It's like, okay, it's not quite ready to execute yet.
Yeah, that seems more sensible. And the reason I like, once a month or less is because if you are executing this type of strategy and you execute it, for example, in this month, well, those positions that you transitioned into, you have to wait 30 days. Now, you could transition into a third position if you ran this next week, but then now it just gets that much more complicated for probably not that much more benefit.
Yeah.
So, keeping in mind this 30-day window, that helps us hopefully calibrate the amount of times we want to execute this strategy in our minds a little more better. And, as we mentioned, most of the benefit will come from these very few periods. So probably being a little too aggressive on running this will not likely provide the amount of benefit that would be worth the time and effort.
Yeah, I agree with that. That's what, yeah, that's a good point. So we'll do the, yeah, I think it's gonna be something like 5%, maybe even more. But if you set this up and you get an alert, then, you'll have to kind of tweak it over time, just like everything else. We'll have to tweak it over time to make sure you're getting notifications less than once a month.
Yeah, and it's something that's kind of empirical, because there may be some periods where you go years without getting it, and you're like, "What's up?" And then there may be some periods where you're getting it every now and then, because the market tends to be seasonal in nature, meaning there are some seasons where the market is just more erratic, and there are some seasons where the market is just more calm. And if you're in a protracted longer season where things are calm, then it just may not trigger as much.
Yeah. Okay. Do you happen to know what your alternative ETFs would be?
They're the Schwabs.
Okay. So same things I mentioned, the SCHV, SCHG is large cap, value and growth. I think it's SCHA might be small cap, but that might be small cap blend.
No, you're right. SHA. That's
yeah. Okay. So we got you script checks daily, only get alerts less than once a month. I mean, that's good. That's a good phrasing. Again, everything about this was like check often, execute occasionally, but trying to like define those has been. I don't know if we've been helpful in that regard. Like, I can tell that we're guessing just as much as anyone else.
It's definitely something where it's not set in stone. And the other thing is, with a strategy like this, it's one of those things where you hear the concept, but when you actually go down towards implementing it, well, that's where typically I'd say most people don't end up implementing this type of strategy, because it does get tricky if you're trying to actually pull it off, to be honest.
Yep. So check daily, get alerts less than once a month, execute on average once a year. And again, that might be like 1 year you do it twice, and then you don't do it for the next 2 years. Have your alternative ETFs ready. Careful of wash sale rules. So it's even possible. So kind of, if So here's a good example. So market goes down 10%. We sell out of check lots. That's another good component. Check the lots. Some of our lots go down. We sell those lots and buy the Schwab ETFs, and then the market drops another 10%. So and let's say it comes to 31 days. Now, what would you probably do now?
So, I would run the software again, and it would just spit out what it's supposed to do with the iRebal. But if I was coding the software, then yeah, what it would probably do is it could transition back to the original shares, back to the original Vanguard ones for the ones that were held, that are now down 10%, the Schwabs. And then the ones that are down 20%, or sorry, the ones that are down, potentially down 10% that weren't down 10% in the first run. I hope that's not too confusing, but there might be new ones that are down from the Vanguard at this point because the market has fallen back more. Well, those you could transition into Schwab.
But I think that would violate a wash sale because
but you have to be careful of
because if you're selling the Schwab to realize that 10% loss, buying does the wash sale go backwards? I think it does.
Yeah, you can't jump back into the Vanguard from the Schwab without waiting the 30 days either, because if you plan on selling that, then you might run into an issue.
So I do know, one, you could then sell all the Vanguard, all the Schwab, go into a third ETF, which let's say it's the iShares one. That is a possibility, but now you have 3 large cap growth ETFs in your portfolio. You also might get in a situation where if it's come down 20%, eventually you'll pick kind of the bottomish. You won't get it exactly, but you get closer. Like when you wait 30 days, it has gone up, and so now any of the Schwab or iShares that you tried to sell would have a capital gain. So that's why we gotta be careful. Sometimes it might just be okay. If it went down after doing the loss harvesting, maybe just harvest the loss on the Schwab, which would be short-term losses. Go back to the Vanguard. We don't need to kind of get that extra 10% loss on the Vanguard side. Does that make sense?
It does. It's just in my mind, I'm thinking, oh boy, you really don't want to run afoul of the wash sale rule for.
Well, yeah, but it's like if you, so in this case, you sell the Vanguard, because market's gone down 10%. Sell Vanguard, buy Schwab, wait 31 days. If it's gone down more, the Schwab has a loss. You sell the Schwab for the short-term loss, but you don't sell any more of the Vanguard. You only you transfer everything else that was in Schwab, sell it for a loss, and buy it back into Vanguard. So the lots that on the first day didn't have a loss, we chose not to sell, but because the market fell 10%, they now have a loss. That loss we're not realizing.
Right.
And that might be an acceptable way of kind of reducing complexity. That if you're in the alternative ETF, don't just kind of wait to 31 days, move from your alternative ETF back into your first one.
Yeah, it kind of even points to our earlier notion that the less often you run this, the better. So you're not running into these scenarios where you're running it and then, whoops, too early. Let's run it again. Whoops, let's run it again.
That's a good point. It's hard to predict the future. We don't know if it's going to keep going down, but the loss needs to be kind of enough to make sure we don't violate watch tail rules, which is why like things like the direct indexing, where we have a portfolio of stocks, like it's easy to sell IBM and buy HP, and then you sell both of those and buy Apple, and then you sell that and buy Dell. You can kind of keep moving around within the same industry and replicate the S&P 500 because there's enough components that you're not worried about that.
Right. Yeah. And, just to bring this back to the high level for just a bit. So what we're really talking about here is maybe a long-term benefit of 30 to 50 bips a year.
I've seen, I've had these conversations with clients as well. I've seen kind of good research that it can average on the scale of a 1% per year benefit. But the research is usually incorporating 2008 or 2001, 2002, 2003.
And
So like,
is that net or gross
uh,
fees?
good question. I do think it's net of fees, but it's very possible it's gross of fees. So I acknowledge that off the top of my head, I don't know. But either way, again, this was research from Parametric. They were doing an active perspective. So their expense ratio was 70 basis points or so. So that they were still generating tax alpha greater than 1%. But it's possible that is gross of fees. So maybe that is lining up with that 30 basis point benefit per year over 20 years. But a lot of it, like, it's hard to say if you did the same research from 2009 or 2010 to now, which is a good 10-year time frame. Like we have a good data. It's possible just didn't have the big downturns to really build up the value.
Yeah, that's right. And on $100,000, like let's say it's 0.5%, we're talking about $500.
Yeah.
And if you're spending a lot of your time implementing this, you probably want to do it with a good amount of money, I'd say.
Yeah. You can, so yeah, I think that's a good point. I think if you have $100,000, wait for the headline news. It's down 30%, something like that. If you have more, and so now the 35 basis point cost is $3,500, but the benefit might be $5,000 to $10,000, then maybe it's worth your time. But also at that point, like, do you want to actually do this yourself or use a program that does it? I think I try to address with clients. There's definitely value here. There's good research that it is consistent through volatile markets. It does kind of make up for its fee. That I'm very confident in. It might take a decade, but when those events happen, it does make up for the fee. But it is just a marginal benefit. The asset allocation is still the most important part. That weighting of stocks and bonds. If you put together that strategy and just never change it, well, your portfolio get a little more aggressive. It's like rebalancing helps a little bit, but yeah, it's a marginal additional benefit, but it is something within our control. So yeah, if you don't want to do it, if you just want to buy, was it VT, the single ETF for the all world stocks?
Yeah,
I have no problem with that.
Yeah.
So yeah, I agree. This is a marginal benefit, but there is a benefit.
Yeah, and if you recall, a couple of weeks ago, we talked about the alpha that advisors may bring to the table. We sourced some numbers and insights from the Vanguard research, which said, that there's a lot of things that advisors can help with. And I think at the end of the day, what we saw based upon that research is, having an advisor across many different things, behavioral and whatnot, in addition to other things, could add about maybe 3 to 4% a year. And interestingly enough, tax loss harvesting, wasn't one of those things. But, if it was, it would probably be, not the lion's share of all the other things that you could do to bring you more in line with what you should expect from, like a market level return.
Yeah. Okay. I think we wanted to try and keep our conversation today kind of concise and quick, and I think we went longer than our normal conversation.
Whoops.
But thank you. I think I love the idea of being able to explain when there is a benefit, because there's so many things within financial services that the benefits are kind of too intangible, and clients are concerned is the value there relative to the cost. And this is one of those things I do believe there is that value, and I like being able to go down into the details and really explain it.
Yeah, and I like the fact that we dug into this, because we do hear about it a lot, and it's one of those maybe the buzzwords about what you can do, but when it comes to the nuts and bolts of it, I think there's a lot more going on than kind of meets the headline. So I definitely enjoyed the conversation.
I agree. Well, thank you, Trishul. Thank you for giving me your insights and sharing me with what you do on your portfolios.
Well, thanks, Aaron. I enjoyed digging into the details with you as well. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.